Good afternoon and welcome. I'm Susan Weber, your moderator, and I would like to welcome Willy Walker, Doug Bibby from NMHC, Bob Broeksmit from CMB, he's a CMB with MBA, and Jeff DeBoer with the Real Estate Roundtable, who will discuss the next $1 trillion plus stimulus bill being crafted on Capitol Hill and its impact on the multifamily mortgage and commercial real estate industries. Thank you for joining us, and now I will turn the call over to Willy.
Thank you, Susan, and good afternoon, everyone, and welcome to another Walker webcast during a week when all eyes are on Washington. I'm extremely pleased and very thankful to have Doug, Bob, and Jeff joining me today. Dr. Larry Sabato from University of Virginia's Center for Politics was my guest last week on the Walker webcast, and given Larry's comments on the distance between left and right in Washington today, it should come as no surprise to any of us that the next round of federal stimulus is disjointed, contentious, and very action-packed. I'm very much looking forward to my three guests' perspectives and prognostications about what the eventual stimulus bill will contain. Unlike most Wednesdays, I'm not going to give my perspective on the markets today for two reasons. First, I have three very talented guests today, and I know we won't have enough time to cover all the territory we would like to cover in the next hour. And second, next Wednesday, we will not be holding a Walker webcast as we announce Walker Dunlop's Q2 earnings on that day. During our conference call with analysts, we will talk a lot about the markets, both inside and outside of Walker & Dunlop. So if you'd like to listen to our earnings call next Wednesday morning at 8:30 a.m. Eastern Standard Time, we'd enjoy having you. So now to my guests. The three of you have been exceedingly busy men over the past 4 months as the COVID pandemic has not only gripped our nation, but turned all eyes on Washington for how the federal government can help. Doug Bibby, president of the National Multifamily Housing Council, Bob Broeksmit, president and CEO of the Mortgage Bankers Association, and Jeff DeBoer, founding president and CEO of the Real Estate Roundtable. I'm going to start with you, Doug, and just go around the horn. Since the beginning of the pandemic, the good, the bad, and the ugly that you've seen from your seat?
Well, the good is that the markets have continued to operate fairly well, given the extremity of the downturn and the abruptness of it. So I think that's reassuring. The bad is that we have what you just mentioned, an impasse in Congress at a time which is totally critical for us, and that also is ugly. But I'll give you that as my top line. But that's about it from my perspective.
So Bob, the good, the bad, and the ugly from your perspective.
Thank you, Willie. Thanks so much for having me on. And the good, I think, is that the mortgage market has remarkably continued to stay strong throughout this. As the crisis deepened, it seemed like a game of whack-a-mole. Every day there was something else that might prevent real estate finance from continuing, from appraisers being leery of setting foot into strangers' homes and people not wanting strangers in their homes, to county courthouses closing, to inability to verify employment, the very basic parts of lending. And then, of course, a complete freezing of the market. To Doug's point, it's functioned well, but there was a scare, certainly, when nobody was buying anything but treasuries. And then the Fed, of course, stepped in, and mortgage markets got back to sort of normal, actually. And what's been really remarkable to me is that for 9 weeks running, purchase money applications have been higher than the year before period. So when we started the pandemic, they were about 35% behind because of all the closures. And now they're ahead 9 weeks running, which to me is remarkable. And these low interest rates are a form of free economic stimulus as people can refinance and buy more house than they would have otherwise. The bad and the ugly, of course, are the suffering that so many Americans with these enormous, unprecedented unemployment rates are going through. And really also, and this is good and bad, the real awakening about the racial inequalities in this country, which of course started from a bad, ugly event, but has really, I think, has the potential to move the needle in ways that we haven't seen in generations.
Thanks, Bob. Jeff?
Well, I guess I would approach this from just, since I'm focused almost entirely on Capitol Hill, I would look at it from that direction. I would say the good is the speed and the depth that Washington initially reacted to the problem. And the bipartisanship that was shown early on really was pretty breathtaking. The scope of these bills that were done at the beginning of the awareness of the pandemic were very, very deep, trillions of dollars, done in a bipartisan way, done very, very quickly relative to the way that Washington typically works. And I think if you just look back at the great financial crisis, how long it took Washington to do and react and to start to put policies in place to help a recovery, you'd have to say that early on in the crisis, that was a good thing. I think the bad, as we moved along from that initial activity, the bad is that it started to unravel and relief started to be politicized, that there was a misunderstanding of the types of businesses and others who needed relief and what kind of relief would come. And I think the ugly is unfortunately almost where we are now from a political point of view, where partisanship has returned in a big way, and it's going to make getting this next bill done more difficult than it should be. And I think providing relief in the way that it should be provided is also going to be not as robust and as deep as it otherwise could be if some of these partisan arguments and points of view could be set aside. Of course, we're in an election year, so what more can you expect? But again, all in all, I think, again, it's bad and ugly that a lot of relief that has been done hasn't been enough, that we haven't moved out of this crisis, and that more seriously needs to be done. So
I want to start with housing, since it squarely falls into all three of yours purview, if you will, and what your industry organizations focus on. Bob, I'll start with you diving a little into single family and then multifamily to get your sense of what's happening in the markets. I'll then turn to Doug to go a little bit deeper into multi, and then I'll finish this round by getting Jeff's perspective on housing, and then also ask Jeff to go broader on commercial real estate overall. Then we'll come back and focus on the stimulus bill currently being negotiated and get each of your perspectives on what will and won't be in the final bill and how listeners can help shape that outcome. And then finally, we'll discuss the overall markets and what the three of you see happening going forward. So Bob, as you mentioned in your opening remarks as far as the good, capital has continued to flow. The markets have continued to provide capital. And one of the concerns is the number of single-family loans that are in forbearance right now and what that ends up meaning for overall liquidity. I think right now, the MBA just announced that for the fifth straight week, forbearances on single-family have come down, but it's still 7.8% of single-family mortgages outstanding, or about 4 million homeowners still in forbearance. What's this mean for single-family defaults and the overall single-family market?
Yes, so the forbearance, as you remember, was mandated first by FHFA for Fannie Mae and Freddie Mac loans, and then about a week or so later turned into law in the CARES Act for government-backed mortgages. So that covers about 70% of the market, and a forbearance means that a loan payment is not forgiven, but it is delayed, and typically, it'll be paid when the loan is paid off as a separate account that does not accrue any interest. There are other ways of doing it, but that's the typical way. And so our servicers, with a mandate with immediate effect and no warning, really swung into action and did get, as you said, at one point over 4 million borrowers into forbearance. Now, what that means for the economy and the ultimate delinquency rate, of course, depends entirely on the course of the pandemic and the economic recovery. So we were more optimistic a couple weeks ago before a lot of the southern states and western states were having this big spike and second round and increased tightening of their economies. But generally speaking, the forbearance is permitted for up to a year. And if a borrower after a full year still does not have income similar to the income when the borrower went into forbearance, that of course is where the loss mitigation options are available. And sadly, if someone is still without a job at that point, there will be people who lose their homes. But the good thing coming into this period is that we had record levels of home equity. So unlike at the Great Recession, when property values were plunging, we actually have most borrowers with positive equity. So many will be able to sell their houses should they not get back to work in the way that they were. But we're hoping that with a full year, most borrowers will be back on their feet and they'll turn from forbearance into coming current on their loan and will not have to go through that loss mitigation process.
Have you guys estimated, what's your take on, there are 3.9 million homeowners right now in forbearance, or about 8% of the market. Does half that default? Does a quarter of that default? What do you and Jamie, when you sit around and say, our estimation of this is going to be X? I know that Fannie and Freddie are obviously running as many models as they possibly can, but this is a big number, particularly as it relates to the future of Fannie and Freddie, because if a large percentage of those loans actually end up defaulting, that's going to slow down the privatization process on Fannie and Freddie. If they all get out of forbearance and get back to being performing mortgages, you can kind of see that process happening over the next year. So what's your take of just back of the envelope of what you all are spitballing?
So a couple points there, Willie. First, you have to be an epidemiologist, not an economist, to answer that question, because that's really going to be how this thing goes. But we're optimistic. The overall forbearance rate is lower for Fannie and Freddie than it is for the broader market. FHA has a good deal higher percentage, as does the private market, bank balance sheets and private label securities. And unless we have really significant unemployment 9 months from now, because we're already 3 months into this, then we expect that number to be much lower than your 50% or 25% in terms of who can't get back on their feet after the forbearance. But you know, all joking aside, if we get a vaccine and if the economy bounces back, I think the percentage that will go into foreclosure from forbearance will be quite low. But if we don't, or it takes more than a year, then you could be looking at some significant numbers there.
Doug, let me jump to you quick, and then I'm going to come back to Bob. The numbers that Bob just spoke about on single family are significantly higher than on the multifamily side. Less than 1% of multifamily loans guaranteed by Fannie, Freddie, and HUD are in forbearance. And Bob's point about the amount of equity in the homeowner side of things is paralleled in the multi side. What's your view as it relates to forbearance? The numbers of loans that went into forbearance over the last 4 months, and sort of the outlook as far as how many of those get back to being performing, just sort of single family over to multifamily.
Yeah, I think, thanks, Willie. There are very few loans in forbearance right now. People haven't been tapping those yet. And I think a lot attributes to how well the apartment industry has held up for the first 4 months. And so, I think if we see things go sideways with assistance to renters, for example, if we see the UI benefits either cut dramatically or not continued at all, I think we're going to find a lot more stress in the system. But right now, people have been able to access debt pretty cheaply, and the operating performance in the apartment industry is very, very sound right now.
So if we look at refinancing activity, Bob, on the single family side, mortgage applications last week were up 4% over the previous week, but strikingly, they're up 122% over a year ago. So there's a huge amount happening in the single family space as far as refinancing activity. Is that sustainable, or are we just going to get sort of everybody grabbing these lower rates, and then on the refi side, 21, 22, 23 look sort of bleak as rates start to move back up?
It's a good question, Willie. And for several cycles, we've said, well, gee, now that everybody's refinanced at 4%, there'll never be any more refis. And then we said the same thing about 3.5%. And then we said 3%, which is kind of where we are now. But frankly, with the spread between the 10-year and the 30-year, the 30-year has room to move down even if the 10-year doesn't move, meaning that there will continue to be significant refinance opportunities for quite some time. Now, obviously, as 21, at least after the first half of 21 and into 22, we're certainly projecting a much lower pace of refinances. But the purchase market, buoyed by demographics, household formation, millennials becoming homeowners a little later than some other generations, but nonetheless becoming homeowners, and what we expect to be low rates for the foreseeable future will really buoy the purchase market. So yes, refinances will drop after 20, but from an incredibly high level. And at a certain point, cash out refinances will pick up as well. So we really see these low rates sticking around, I don't want to say indefinitely, but for several years. And just as an aside, when the Fed, after an 11-year expansion, never got around to deleveraging its balance sheet and reversing the quantitative easing, they're kind of stuck in that pattern for an indefinite period, which we think will be a real downwind, tailwind for low rates.
So Jeff, you've heard Doug and Bob just talk about liquidity in single family and multifamily. What about other commercial real estate asset classes, hospitality, office, retail? You got a lot of members of the Roundtable that own a lot of assets in those categories. What's liquidity look like on that side? Is it as bright a picture, or are you hearing a lot of bemoaning about the fact that there's no capital out there for those asset classes?
No, it's not a dismal picture. I mean, debt and equity markets are largely open, for most real estate, office, certainly industrial. We just heard about multi and single family. Hotels and retail are probably the areas that we all know that have suffered the most and probably continue to suffer the most. But we don't really hear about a problem getting capital if you've got, you can get capital out there. Now, construction, if you're going to do construction or transition a building or something like that, that's a different story. But straight ahead debt and equity is available by and large. The problems really, as we hear about it, revolve around loans that have been packaged, securitized in the CMBS, into CMBS pools, particularly pools that are dominated, obviously, by lodging or retail assets. That's a very difficult situation, and a number of those loans have moved to special servicing and so forth. And that's really the immediate problem. There is the overhanging problem and concern about, and in the multi space in particular, what happens when and if Congress ends the very robust financial support through either the PPP, the unemployment, the added unemployment, the supplemental payments and stuff on top of Section 8 and stuff. If that starts to burn off or be ended before the economy comes back and before jobs comes back, we're highly concerned, and I'm sure Doug and Bob are too, about the ability of people to meet their rent obligations without those. So that's a problem that we hear about. And certainly in the retail space, that's where the current inability to pay rent, it's very hard for a lot of these retail businesses to meet their rent obligations, although surprisingly the numbers are better than they were last month, and they were better last month than they were the month before. So even in retail, it's trending in the right way, but can it continue, and will it continue? And it all really comes down to this virus and finding a vaccine and so forth, doesn't it? But
you certainly.
Go ahead.
You sent me a document yesterday that had 65% of retail rents being collected during the month of July. And the question would there be, that's a better number than it was in June. And at the same time, can you pay your mortgage and can you afford to hold on to the property at 65% rent collection?
Yeah,
on that, let me, go ahead, Doug. Go ahead, Jeff.
It's important to understand within those numbers too, how that does break out, because the overall retail numbers would include, CVS, would include grocery stores, would include other types of retail which have remained open for, maybe they were essential businesses or they just remained open for whatever reason. Apparel and other types of retail, restaurants obviously, are where the real pain is. So that number can be a little bit deceiving when you dig into it a lot. And obviously if you're a owner that has grocery anchored assets or other types of assets versus a owner that is covered space, all apparel type of retailers, it's a much different picture.
Right. So Doug, your rent payment tracker, kind of going on what Jeff just said as it relates to collections, your rent payment tracker has been without a doubt where all eyes have gone to after the first 15 days of the month, and then you've got data coming out today on the month of July. But if you look at it, you're tracking 11 million rental units across the country, and from July 1st to the 20th, you found that 91.3% of households made a full or partial payment during the month of July, and I think you're coming out with numbers today that bring that back up. So it's down 2% from last year. And down 90 basis points from June. Have you been surprised how well rents have held up?
Yeah, Willie, we just released this morning, and it's 93.3% versus 95.3% the same 27 days last year. So you're right, 2 percentage points difference. I went into April terrified. I got a bit. I was very, very afraid of what's going to be happening in the marketplace. But we asked our members to really reach out to all the residents, to work with them, to identify resources for them. I give them a lot of credit for doing that. I give the residents a lot of credit for treating their credit histories very seriously. But the ultimate deciding factor in this thing, as I mentioned earlier, has been the unemployment insurance benefits. And that has buoyed the market remarkably and kept everything on an even keel. And that's why, as I said, from an operational point of view, we're very, very strong right now. But then now looking forward, we just don't know where we're going. I'm happy to talk about that further. But
yes, now, I do. We'll get into extension of unemployment insurance and all that other stuff in a moment. But I guess the question I'd have, Doug, is there's a lot of work being done to make sure that the if you will the various components that have helped the multifamily industry continue into the next stimulus bill. But if you look at it kind of just from the numbers, if you look at, collections down on a monthly basis, not only in the first 15 months, but on a monthly basis, April, May, and June, we're in sort of a 1 to 3% down from previous years. Now, obviously, people need to live somewhere. And so we want to make sure people can stay in their homes. And we're going to talk a bit about the eviction side of things. But I guess the question I have is, do we have any sense of how much the stimulus has held those numbers up? In the sense that if you look at April, people still had the money that they were making in March before they either got furloughed or laid off that allowed them to make that April payment before the government money started to flow. And then clearly May and June held up due to the dollars that came from the federal government. But is there any number that's been done that said that were it not for all this federal stimulus, rent rolls would be at 85% or at 70% or down in the 65% that Jeff just talked about on the retail side of things, were it not for these stimulus dollars coming out?
Yeah, Willie, I think when you look at the average net worth of a renter household, it's about $5,000, okay? So you start there. It's a very thin cushion. And then you think about the jobs that people who live in apartments have, and there are a number of workers in the gig economy. There are people who are on commissions and on salary plus bus tips or bonuses, a lot of variable income there. And I think so you have a very thin cushion, and you have people who are very vulnerable in the economy. And they have been buoyed, as I said before. It's been an enormous positive thing for the apartment industry. That margin is really, really thin. And I think we've been able to hold our own because of those benefits.
Bob, if we focus on the role that Fannie, Freddie, and FHA have played in both the single as well as in the multi-space, you clearly have members in MBA who represent other capital sources. They work for life insurance companies. They work for the big commercial banks. They work for investment banks that are doing CMBS originations. What are they saying to you as it relates to either their desire to deploy capital into the market today or something structural that needs to be changed, whether it's the Fed needs to be going in and buying CMBS on a more broad scale or whatever else to maintain liquidity in the non-multi, non-single family space?
Yes, Willie, you're right. The MBA is a big tent with lots of capital sources, and on the side away from Fannie and Freddie with life insurers and banks and CMBS, there is, of course, a lot of caution around asset classes that are not rentals, meaning tenants, apartments. And there is some move to try to get the Fed to broaden its purchases of asset classes and not only newly issued CMBS, for instance, but also some vintage CMBS to give some confidence to the market, because clearly you are seeing real distress in some places. Industrial is a bright spot, but these other hotel and retail, of course, are suffering, and retail. And one of the things that can help is I've seen accounts of really significant dollars being raised in private equity, for instance, to invest in this. But of course, they're not looking to invest in it at 102 cents on the dollar. They're looking for a discount. So there will be capital sources, but the question is, are there policy-related things that we can do, for instance, through the TALF program at the Fed, to inspire some confidence in the market and get that capital flowing?
Let me ask a potentially sort of might sound a little callous, but I thought one of the great parts about CARES was that it really focused on the American consumer. CARES put money directly out to the American consumer to be able to deal with the pandemic, deal with the shutdown, and get to where we are today. And it didn't, to some degree, going back to what Jeff said previously, focus on things like the Troubled Asset Relief Program that happened in the Great Financial Crisis, or kind of focusing on big industry. If I look at CMBS loans, historic vintage on retail, hospitality, office, is it really the role of the federal government to step in and sort of bail those loans out? Or should the owners of those assets and the people who provided that capital just sort of deal with where the markets are today? I mean, we know that there's plenty of liquidity. It might not be at the price point they want, but I guess just pushing a little bit on MBA trying to step in and try and get a broader buying of CMBS. Is that really where we ought to be spending our time and effort?
Well, it's a fair question, Willie. And I think the answer really lies in what is the ultimate goal in a health crisis. So I think what you're saying is that some of these properties and some of the collateral perhaps was heading in a bad direction anyway, and this accelerated it. But do we want, as a country and as an economy, to have all the jobs that are tied up in all these endeavors to disappear overnight, and then have all the collateral damage of, as Doug said, people need a place to live? And is this really such a unique point in our history that we're willing to give some aid, particularly at a time when the Fed's reach is so deep, and it's gone in for money markets and municipal bonds and all sorts of other things? And you can definitely draw a line that says, if they went into these asset classes, it would help the economy and help people stay on their feet. So as a purist, as an economist, I think you could say that, let the chips fall where they may, but there's some real economic fallout at a time when the country, frankly, is really weak. And the question is should the Fed step in and ameliorate that a little bit?
So Jeff, you have a number of members of the Roundtable. Your chairwoman is CEO of Ventus, a huge seniors housing operator, and clearly seniors housing has been sort of the epicenter of the COVID pandemic and has been really badly damaged by the pandemic. And then you've got, lots of big retail operators, lots of big hospitality operators. what have you seen as it relates to sort of the way they've dealt with the pandemic and anything from an innovative standpoint? I had Jeff Blau on the Walker Webcast about a month ago, and Jeff was talking about repurposing the Neiman Marcus at Hudson Yards into potentially a new tech company headquarters. And I sort of scratched my head and sort of said, man, that's got to take a lot of time and a lot of capital to repurpose a Neiman Marcus and turn it into a corporate office space. But have you been seeing your membership doing innovative things given the sort of shifting view of the economy and where economic activity is going to happen, maybe not today, but 6 months from now and a year from now?
Well, I think more, I'm hearing people explore ideas, and smart companies obviously are thinking about this and thinking ahead, and how can they be innovative? How can they change? How can they be better? Frankly, when we come out of this, hopefully there will be differences, but some of them will be better and some of them will be good. And I think a lot of companies are certainly thinking about that. We're not really seeing it in practice yet because people are focused on the current problems, of course. But I do think that there will be all kinds of innovative new things that real estate operators, all product types, from hotels, shopping centers, office buildings, everything will evolve to react to this. And frankly, I think it will be a good reaction. I think it will be a positive reaction. I just want to comment a little bit on some of what was said. I think that while unemployment has been very, very helpful for renters, let's not forget the PPP, the Payroll Protection Plan. And there's been about $520 billion that has been distributed from that program to, I think, somewhere around 5 million businesses. And in order for that money that has been distributed, that $520 billion, not to be a loan to the business had to spend at least 75% of that on payroll. In other words, going through to employees, in many cases, employees that weren't even working. So in theory, that money was also supplementing unemployment and supplementing Section 8 or supplementing what other savings that people had. And that's been really, really helpful. And so let's not forget the tremendous assist that's been done there. The other thing that I think it's
Jeff, on that, just before you jump to the other point, are you working to try and make it that if there's another round of PPP, that they can put more of that to rent? Because if I'm an owner of a hotel shopping center, and 75% of that money has to go to salaries, and then they say I've got to pay a number of my suppliers and I'm going to hold back on my rent, that's a tough place to be in. If they lowered that to 50% and allowed you to then use the other 50% to make rental payments, I'd assume that would be helpful to the industry. Are you focused on that in the next round?
Yeah, very much. And we've been focused on it really from the get-go, as they say. But having said that, I don't want to say that we're trying to take money away from people who have lost their jobs and so forth. That's very, very important. They need that. But providing businesses with more flexibility, because in many cases, they have to pay their rent, they have to pay their utilities, they have to pay their taxes and so forth. So we've, from day one, urged that there be more flexibility in order for that loan to be converted. And in fact, in the last bill, or in a separate bill, I should say, about a month ago or so, it kind of blends together, the 75% was reduced to 60%, allowing, more flexibility for businesses. I think in this round, you might see additional flexibility for businesses to spend the money. So yes, certainly we're very, very focused on that. The other point I was going to make about this crisis versus the financial crisis, the financial crisis was a financial crisis, and it was caused in many respects by issues in the financial system and by practices in the financial system. And so credits that were impaired in that situation were impaired because of problems in the financial system. And so when Congress addressed that problem, they took a different tact, or they took, an approach that was much different from this, because these credits, real estate credits, whether we're talking about retail credits or what have you, are impaired not because of financial engineering or over lever or over poor underwriting. They're impaired because the basic income has ceased on some of these assets because of a health crisis. And so the solution has been a different solution, and it's required a different tact here. And sometimes that's lost in some discussions. I just wanted to highlight it a little bit.
Yeah. So let's transition to this next round and what we're looking at and kind of the key issues that the three of you are both focused on and what we're likely to get as it relates to this next stimulus bill. Because clearly in the multifamily space, from all the comments that have made up until now, the PPP loans, the unemployment $600 a week boost to the unemployment benefits, and the eviction moratorium have been major components of the CARES Act that have both helped and hurt the multi-space. So Doug, let me start with you. I mean, the original proposal in the HEROES Act by the Dems was a $3 trillion bill. It extended the $600 a week all the way until January of next year. It extended the eviction moratorium until January of next year. Actually, I think it was even a full year. It also had money for PPP. And now if we go with the Republican proposal, we're at $200 a week of additional unemployment benefits. We do have the $1,200 one-time sort of stimulus check that was paid in the CARES Act that has now been replicated, which quite honestly surprised me that was in there. There's talk of the $500 per child and potentially even stepping that up to the $1,200. And then the liability protection, which is obviously a very important component to what the Republicans want to see here. And then no extension of the eviction moratorium, even though that's high on the Democrats' list as it relates to things they want to see into the bill. So go through and just kind of handicap from your standpoint, what's NMHC need to see in that bill? And then I want to run through to Bob and to Jeff to get their feelings on those kind of major components, and then anything else that needs to come in.
Yeah, thanks, Willie. I mean, it depends on what day it is that you want to address this and try to handicap it. It changes from day to day, but I think there's no possibility of these two sides getting together over the next 2 days. So we're going to hit the cliff, and so what's going to happen, and what we expect to happen, Thune was hinting about that yesterday and this morning as well, is potentially just a new date for the CARES Act that allows them to carry a couple more, maybe 2 to 3 weeks more with the unemployment insurance benefits going out while they arm wrestle over what happens. There's no direct assistance to renters, but there's no eviction moratorium in the Republican bill. But the UI benefits are down to a point where they put a lot more stress in the system. And we don't think it will stay there. We think it will come somewhere in between the two. And the liability protections are very, very important to our owner-operators. So I think it's really hard to handicap anything right now, but what we do expect is an interim measure to try to keep the markets stable to the extent they can while they negotiate. The other, Bob and Jeff may disagree with that.
Doug, just one question. Let's just say hypothetically that what's on the table by the Republicans right now, $1,200 additional payment, $200 a week supplemental unemployment insurance, and all the other, and no eviction moratorium extension. Is that a good bill for the multifamily industry?
No, Willie, it's not. As I mentioned before, the renters in this country have a very thin margin. If you drop it down to 200, you're now vying for rent with food and healthcare and other the car payments or whatever else they have to do. It puts a lot more stress in the system than we can tolerate right now. So
if you're Mitch McConnell and you have a question of trading out an increase of the 200 to 400 a week, yet you also are going to put in an extension of the eviction moratorium, do you take that deal? Is the money more important than the eviction moratorium, or is the removal of the eviction moratorium more important than the money?
No, the money's more important. I'll tell you why. We haven't had any eviction problems in this country, even though tens of millions of people lost their jobs and tens of thousands of businesses went out of business. And the reason we haven't had an eviction problem is because of the money that went out and the UI benefits. So if you're asking me, that's what's really going to make the difference there. And the eviction moratorium doesn't accomplish anything. It doesn't get to the core of the problem, which is people don't have the resources to pay for the panoply of things they have to pay for.
So Bob, let me turn to you as it relates to sort of the laundry list of things that are out there and where MBA is spending time and effort. Clearly on the housing front and multi, those are important to you. What about general market liquidity? A lot of what's going on from an MBA standpoint happens at the Fed and not necessarily in the CARES Act, but clearly PPP and stimulus keep the markets going and keep mortgages current. So what are you all focused on?
Well, like Doug, we think that the money to consumers and to homeowners and renters is critical. And what combination that comes in versus, for a stimulus check versus expanded unemployment continuance versus more money for the Paycheck Protection Program, all of those are important, and they're important components of this recovery. And we feel as though staying away from mandates in the housing side, like moratoria, as Doug, I think, said, if you've got the money, you're going to pay the rent. And if there's a moratorium, one could see a case where the renter gets the money and chooses to do things other than pay the rent. Now, we haven't seen a lot of evidence of that. I'm not saying that's going to happen in a lot of cases, but it is a risk. And the other thing I'd mention on the unemployment benefit side, I think that Secretary Mnuchin and this administration have done a good job of saying, look, we don't want to overcompensate and pay people more than they made when they were working. And we'd really like to hit at some formula about 70% of their previous income, but it's so complicated because the states all do it differently, and it would take an awful lot of time to get that right. So just like the Paycheck Protection the initial stimulus checks, you saw stuff in the media about dead people getting checks. Well, guess what? If somebody's alive today and dead tomorrow, you mailed a check yesterday. I mean, I don't think we can criticize that because there was such a need to get it out quickly. So whatever imperfect compromise emerges, and your $400 may not be a bad one, we think that that's really critical, and probably we won't have time to get it perfect in that some people will make a little too little, some people will make a little too much, but that seems like a good place to land. And let me just say one more thing on the housing side. The Democratic proposal would mandate forbearance on loans that are not federally backed. Non-federally backed loans, those on bank balance sheets and private label securities, are in forbearance at about a 50 to 60% higher rate than Fannie and Freddie loans. So those investors are already working closely with their borrowers and offering forbearance, and we don't believe a government mandate in that regard, particularly at this point in the process, is required. So we are advocating against that piece of it.
So Bob, before I jump to Jeff on his point, his thoughts on this, Bob, all three of you spend a lot of time with legislators on both the right and the left, and a lot of you also spend a lot of time with economists. At a time when the federal government is issuing debt at 68, I haven't looked at the 10-year today, but at 68 basis points or 65 basis points, how can a fiscally conservative legislator with a good conscience sit there and say, we can't afford to put another $1 trillion or $2 trillion into the economy today, given that it's essentially free money to the federal government?
Well, it's a remarkable time, Willie, because you had, I forget the exact vote, but if it wasn't unanimous, it was close on the CARES Act for just enormous spending. And as you've seen in the Republican caucus in the Senate, you've got senators who, yes, perhaps with an eye toward 2024, but also just with an eye toward their heritage and their beliefs, said, gee, this is a whole lot of money, and we can't just keep spending forever and ever. Now, to your point, it has gotten cheap to borrow, but it's still, at some point, you got to pay the piper. And I suppose as long as we're the world's reserve currency, we can just keep printing money, and you can issue 50-year debt at 60 basis points, and I guess we can keep the thing going. But it sure doesn't seem right to a fiscal conservative to just keep writing multi-trillion-dollar checks and hope it all works out in the end.
Yeah, Jeff, you want to pick up on that question to Bob, and then go into, you look at these issues a little bit more broadly, if you will, than Doug and Bob, because they're so focused on the housing industry and the mortgage finance industry, and also the role that Fannie and Freddie and HUD play in the single family and multifamily housing space. You've got a broader mandate of what you need to make sure gets into the next round of stimulus. But just as it relates to that point on can't we afford it and kind of this whole fiscal conservatism right now, should that issue just be off the table and we ought to just be spending, or are you hearing really salient points of just sort of saying, you know, we can't afford to keep going down this path?
Well, I think, look, I think Bob described it quite accurately. I mean, I think it's more of a number than a cost. And so, okay, they've spent $3.5 trillion. Now we're going to spend $5 trillion. Now we're going to spend $7 trillion. I think it's just a number that is causing great fatigue for conservatives. But on the other side of the coin, when you have a national debt that is getting to be such a high percentage of the overall GDP, it really isn't a matter of the cost of servicing that ongoing debt. There's other issues that come into play. And I think some, particularly on the conservative Republican side of things, are concerned about that long term. So, and I think that they're also starting to wonder how some of this money is being spent. Is it being spent, or is it being hoarded by people and businesses and states and localities? Is it being allocated? Is it being allocated to problems that are COVID related, or is it being used to improve problems that were pre-existing? And so I think there's a lot of questions out there that are causing pause, but I do find it hard to believe that they will leave DC for their August break without reaching an agreement. So I am optimistic that there will be another bill. The Democrats want $3.5 trillion. The Republicans have a $1 trillion marker out there. I think certainly, Willie, you understand the difference between bid and ask, and sometimes you probably come in between bid and ask, don't you? So I think there's going to be a bill, and I think it's going to be more than $1 trillion, and it's going to be less than $3 trillion. From our perspective, you know, look, I'm taking on the multifamily side, I take my lead from Doug and Bob and you, frankly, and so what they're saying is what we want. Now, on top of that, we do have a broader mandate and a broader area in the commercial real estate to look at. So, and by the way, the House $3 trillion bill does have a separate renter fund, renter assistant on the residential side of things, roughly between 150 and 200 billion. I'm not sure where they settled, but a sizable fund that renters, residential renters, could tap into if they could demonstrate a impact from the COVID. Seems fine to me.
And as
I also think that go ahead, I'm sorry.
No, go ahead, Jeff. Joe, go.
Well, I was going to say that same concept, in our view, applies to on the business tenant side of things. There's many businesses, particularly small businesses, who simply cannot meet their rental obligations, and a rent fund there would be assistance. And we're not in this basically just for landlords to get their rent. The rent chain itself is such an underpinning, I should say, of the foundation of the economy. That rent goes up to the owner, who pays his or her own staff and payroll and maintenance people. It then goes to the holders of the debt on those assets, the holders of and it pays for utilities and state taxes. It pays the investors. It helps state and local governments. So this is extremely important, not just from a landlord point of view. So if I had to say our number one priority would be to try and provide more rental assistance to business tenants. But beyond that, you know, businesses are all going to be undertaking tremendous amounts of expenses to keep their workspace clean and healthy, new protocols, new disinfectants, new types of things. And these businesses, whether they're real estate businesses or businesses in general, should have some assistance from the government in these expenses, which are new and unusual, and we don't even know, but people should be encouraged to spend as much as possible to keep our people and our guests safe. So we want to see something in this bill on that. And then if you look on the tax side of things, there's no question that a lot of debt is going to have to be restructured and reallocated and repriced. And under typical situations, obviously, when that happens, there is a tax situation that will occur to the borrower if he's being relieved of some of his or her debt obligations, as it probably should be. But there can be changes made now to the cancellation of debt income tax rules that would not make that tax liability go away, but would spread it out or would find a different way for people to go forward. So we want to see something on cancellation of debt income, maybe not this bill, but somewhere down the road soon. And then there's the other situation, getting back to retail. There are a lot of retail owners, big owners, who would like to invest either debt or equity into troubled retail tenants in particular. And this is not just in retail, but in other areas. But there are tax rules that would inhibit the owner to put in that additional debt or equity into the tenant in order to help them along. And we'd like to see those rules modified. Again, the idea really, we have to be thinking about this as we're building a bridge. We're building a bridge to a time when the economy works again, when businesses are open again, when people are employed again, and people can stand on their own 2 feet. But we need the bridge to get there. And they started pretty well with the CARES Act, and we've got to make sure the bridge is strong enough and long enough to get us to that time period. And some of these things, like this equity from retail owners or other owners into their businesses or debt into those, that's helping the situation, and public policy should be encouraging that. And then the final thing, Willie, is what you opened up with, is really liability. I think all owners of businesses and all schools and all hospitals and just about everybody is concerned about the potential litigation risk that is coming if we don't have some general rules of the road, that if you follow them, you're doing what a reasonable person would do, and you should not be subject to huge litigation risk in that. So we want to see that.
And as we know, that's a cornerstone of the Republican proposal. So I think it's probably, we can handicap that pretty well, that there's going to be some type of liability protections that are in this next round of stimulus.
And by the way, let me just say on that, Willie, yeah, the Republicans have made a case of that, but I don't think it's limited to Republicans. I think that Democrats fully understand.
I concur with that. I'm just saying, I think all the action right now is sitting with Mitch McConnell and the Republicans as it relates to the power base in the negotiations. Yeah. And
I think on this issue, it depends on, I think on this issue, it just depends on how that liability shield is constructed and how long it is. It's not, I could be wrong on this, but to me, it's not, will a liability shield be erected? It's how long and what it does, because again, I think there's understanding that this is something that for the economy to go forward, we need this kind of relief.
So I've got less than 10 minutes and I want to run through a lot of different stuff. So real quick, Doug, I'm scratching my head why Rand Paul hasn't stood up in the pulpit of the United States Senate and said that an eviction moratorium is removing property rights from owners of property, and whether it's unconstitutional or not, it is clearly not capitalist, and that we need to restore property rights to owners of multifamily buildings at this time. Why hasn't anyone stood up and pushed back on the calls for the extension of the eviction moratorium?
Boy, I wish I could give you an answer on that on Capitol Hill. I can tell you that within the industry, there's a lot of talk now of filing suit in certain locales and in certain courts to challenge this, because it is a taking the same way that rent control is at its core a taking. But I can't tell you other than I don't think they really focus on it. It sounds good. The consumer is going to be protected, but they don't. As Jeff said earlier, in my business, a lot of folks are smaller owner-operators, and this is their livelihood. This is their retirement. They could lose that totally with an eviction moratorium because they've got a mortgage, they've got property taxes, they've got insurance, they've got a payroll. Over 40% of the units in apartment units in the country are in buildings of 50 units or fewer. Think about that. Yeah. So that's a very fragmented business to start with. And the eviction moratorium, while it sounds kind of sexy, the same way rent control can kind of sound kind of sexy because it protects the consumer, it has the opposite effect. But I'm as puzzled as you are that someone like a Rand Paul, who's a libertarian, would say this is a confiscation of property at its core.
I will say one thing as it relates to just, I don't want anyone listening to misinterpret my comments about being focused just on the owners and not on the tenants. But I was talking to one of our borrowers yesterday who owns 5,000 apartment units in Denver. 5,000 apartment units in Denver. And of their entire portfolio, they have sat down and either have people paying or on rental forbearance programs and have in that entire portfolio 10 people, 10 units that are dark right now, that are not either paying or on a rental forbearance program to keep them in their unit. That's the proactive nature of people in the multifamily industry to work with their tenants. And these eviction moratoriums make it so that you have a propensity for people to just go dark on you. And that is where the owner isn't working, the tenant isn't working, and where you lose the sense of community in those multifamily properties. And that's, from my standpoint, at a time when we need so much sense of community across our country. By putting in an eviction moratorium, you lose the ability for owners to manage their properties and maintain community. And that has real long-term implications to them.
Willie, I think also that neither policymakers nor the media understand this. An eviction notice is a warning. And the vast majority of those warnings are cured, to your point, where you're left with a very, very tiny percentage of the bad actors. And you know, if someone's doing unlawful things, if someone is not paying their rent and they can, then, you know, we have to have a system where we can act to protect our own livelihood. And so I think that we all have an obligation to help educate this, because the physical displacement is a very tiny fraction of that overall eviction warning sort of scenario.
So, Bob, let me just come to you quick, because Fannie and Freddie have played a huge role in providing liquidity to the market over the last 4 months. FHFA is in the process of creating new capital standards for Fannie and Freddie. There is a plan to privatize Fannie and Freddie that Director Calabria is pushing forward very hard. What's your sense, handicap for me, Fannie and Freddie getting out of conservatorship in the next 2 years?
Well, this capital rule is a big deal, Willie, as you say. It's probably, I think Calabria has said it's the most important rule that he will put out during his tenure. And it's a really difficult needle to thread to say, I want adequate backstop to the taxpayer to make sure that there's not a loss for the taxpayer, but to have the business proposition for Fannie and Freddie be attractive enough from an ROE perspective to get investors to put up billions and billions of dollars in capital. So our preliminary read, and we'll be out with our comments by the end of August, our preliminary read is that the capital required by that rule is on the high side, and it would be unlikely to get raised, save for significant increases in the cost of mortgages in this country, and we're not sure it's warranted. So I know time is short. I'll just simply say court cases pending and to be decided by the Supreme Court probably in the spring will determine whether a Director Calabria would continue into a potential Biden administration or not. And that has a big bearing on whether Fannie or Freddie get out, because I believe a Biden appointee would put the brakes on a release. So I would say less than 50-50 for 2 years out of conservatorship.
Jeff, Bob just gives us a good segue to this question. Biden came out last week with the elimination of 1031 exchanges to pay for education for the young and additional health care for the old. How damaging to the commercial real estate industry would be the removal of the 1031 exchange law?
Well, it would be very damaging if you're in 1031s, that's for sure. Look, all of these things, look, the 1031 issue has been in, like-kind exchanges have been part of the tax law, I believe, since 1921, maybe. And over the decades, the years, everybody asked questions about it. And it has and we've worked with them over the years on this, and the program has slowly been narrowed down where it is only real estate that can be traded in a like-kind exchange. We point out, and Bob and Doug and other trade groups have done studies on this to demonstrate the tremendous impact on jobs, the tremendous impact on communities, the ability to allow smaller, minority-owned, women-owned, veteran-owned businesses benefit from 1031s because they can't access capital. There's not as much leverage in the system when you do this. And by the way, there's a big misperception about like-kind exchanges, and that is policymakers always start out in these debates by saying every 1031 exchange is tax-free. That's not true, point number one. There's always boot, which will equalize the equities on both sides of the trade. That boot is currently taxed, so that's incorrect. And then point number two is they always believe that trades would go forward as sales if the trade section was not in law, and that is simply false. There are all kinds of people who will hold on to their property. They won't put it to the higher and the best use. They won't move it along. They won't improve it because they don't want to pay the capital gain tax. And once all of this evidence comes out, typically, as we've seen over the years, they back off from this. And we expect to have a big discussion next, depending on how the election goes, but have a discussion about this and other provisions that are in the tax law relating to real estate. It might be the interest deductibility issue. It might be the pass-through taxation issue. It might be all carried interest. It could be a number of things. And we plan to do what we've always done, which is factually analyze these rules, determine how they benefit communities, how they benefit jobs, how they benefit the overall economy. And by the way, if these are in the law and they relate to real estate and they don't benefit principally those three categories, maybe they shouldn't be in the law. And I think our industry has to recognize that's the case, and we have to show that we care about our tenants, that we care about residential, we care about business tenants, we care about the overall economy, we care about communities. And that's what we're here for. And by the way, because I know we're out of town, but we care about this racial injustice and we care about this stuff, and we're all working, the three of us are working very hard on this, and the industry, there's a misperception about our industry on this too. And the three of us, I know, are going to work very, very hard and do what we can within the spheres of our influence to improve opportunities, to improve mentorship in our industry, to be a more welcoming industry, and to get out there and do that.
I'm very pleased that you brought that up, Jeff, before we ended. As you know from our pre-call yesterday, we were planning on spending a bunch of time on that, and unfortunately, as I said at the top, we were going to run out of time. I want to get the three of your opinion on three quick questions, and then we're going to close it out. So kind of a speed round here. Stimulus bill gets passed by when, and what's the top line number? Bob?
August 15th, 1.75 trillion.
Jeff?
I'll go with 2 trillion, and I'll go with August 8th.
Doug?
I'll go with August 15 at 1.75, so I'm with Bob.
All right. Next, President November 3rd, after probably November 4th by the time it's all been counted. Biden presidency or Trump presidency? Bob?
Biden.
Jeff?
Oh, if the election was today, Biden. The election's not today, so we'll have to see.
That's a good non-answer. Doug?
Biden.
Okay, and then the final one is, if it is a Biden presidency, do the Democrats have the House and the Senate to then change the tax code? Yes or no? Bob?
Yes.
Jeff?
Yes, they have the power to, but if the economy is still struggling, who knows?
Okay, Doug?
Yes.
Got it. All right, we are out of time. I am hugely thankful to the three of you for joining me. I have to say that I spend a lot of time with my colleagues at Walker Dunlop, as well as with our clients, as well as with my colleagues and competitors in the industry, but there are few three people that I spend more time with on a consistent basis than the three of you. And I'm deeply thankful for both our friendships and also all we have accomplished together on behalf of our industry. Thank you three for taking the time today. To everybody who joined us, thanks for doing so. As I said, next week, No Walker Webcast will be back the following Wednesday. And if you want to listen to our earnings call next week for some perspectives on the market, we'd love to have you. Thanks for joining us today and have a great day. Take care.
Thanks, Willie.
Bye-bye.
Peace and love.